Hey, Peter. There,
Can you hear
Peter.
me?
Got you, buddy.
Oh, great. Good to be with you. Hi, Steve.
Hello, hi Peter. Nice to have you with us again.
Great, thanks. Thanks for
Okay,
inviting me as well. Thanks. Hi, Dale. And did I hear someone say it was your birthday just now?
yeah.
Oh, many happy returns, sir.
You're my birthday present from
Oh,
the company.
hard luck.
Huh? Yeah. Yeah. So, I mean, what a gift to, have some, your conviction about being a dollar bear has helped me out since the summit. And we're knocking on the door of it maybe beginning to break down in the case of the dollar and break out in euro. So if you can share your screen,
Yep.
we'll just move ahead with almost everything you said at the summit is manifesting.
Yeah,
So,
okay. Yeah, we can do an update of that.
yeah.
Do you need to, let me just see.
Steve needs to stop sharing.
Activate
There you
me?
go. And now
Okay.
you share your screen.
Let's see if I can do that. Share screen. It should be, ooh, okay. Screen number one. How's that? It should be coming up.
It
right now.
Yeah, we can see you.
Okay, that's the
Okay.
Nasdaq, I think.
So start wherever you want, but here's my key question. I was talking about this with Steve. Peter, a lot of people said, God, gold is doing so great with the dollar being bid. It's going to be a rocket ship when the dollar begins to weaken, and the dollar's been weakening. And I don't know what you're thinking about here in gold, but we had that little wave 4 triangle that we blew out of to the upside, and since then have negated that breakout. And I'm wondering if this might be changing your view on gold, at least short term.
Okay. Well, as far as the dollar's concerned, we're really, we're set to really accelerate down hard this year. The timing is being delayed because of the impact of the coronavirus. We've seen a lot of hedge funds and investors pile into the dollar as a medium of safe haven, and it's really delaying the process a little bit. And I heard Steve's comments just now, and you were saying, well, the dollar might just have a little flip up if the stock market drops. I believe the stock market is already dropping, and we'll have a look at the Nasdaq in a moment because that's really fun to have a look at. But I think with stocks about to begin a more widespread correction,
Peter, do you think that was, since you mentioned it briefly, do you think that was an ending diagonal in the Nasdaq?
Yeah, that's what I think. You probably come up to the same conclusion then, because I've got it as a fifth wave from here. This is the mid-April low. This is a fifth wave as a diagonal. And I had a target at 96.16 as a measurement. And we got to 96.04.
Almost perfect.
yeah, just a few pips away. And I had a quick look this morning at that decline, just to see if there was any indication that there might be a 5-wave downswing from that high, and there was. So it's not surprising that in the last hour we've just seen the Nasdaq drop again after a little bit of a counter trend rally overnight. So that's all setting the stage for quite a big downswing. And I think if we get down to I've got a very sort of normalized correction to 83.43. That's a 38% adjustment, and I mean that's about 14%, I think, roughly around 14% down. So that's quite significant to get trading. I mean, certainly our clients who are sort of basically exposed on long only funds or whatever would normally be doing some hedging on a 14% downswing like that.
Okay.
So you're right, Steve. It does look like a diagonal, and that we're going to start to drop down. And I was just looking at how the dollar's impact would be, because ordinarily I'm pointing an arrow down here in the bigger context, but there could be a little flip up, and that's what I'm really waiting to see, because I won't be going short the dollar. Whoops, hold on. I won't be going short the dollar. I've got this on another page. I just need to switch it across a bit.
You could use euro as a proxy if you want.
Yeah,
Okay.
I've prepared. Well, I've prepared this dollar index chart to show that if we hold above 98.65 today and the stock market drops quite rapidly, then we could fall back inside the range. So you've got to be careful about that.
Okay.
I'm not. I must admit, even if we break that low, I'm not entirely sure if we begin, an immediate acceleration down. I don't think we will. So it's then a question of selling three-wave rallies into the dollar, this type of thing.
Okay, so this a lot of things are predicated on this correction we're going to get in equities that's going to create a bid for the dollar. I know that you thought yields had bottomed, and I was looking for higher yields over the past 2 months with the rally that we had in equities, and how disappointing it just never happened. So you think we could go down to, what is that, 47?
Well, it could drop down to 47, 48 basis points. Yeah, it could do. I mean, it's a bit flip-floppy, isn't it? The advance from April's low.
But it didn't perform with risk on for the last 2 months. That's what gives me pause right here, that I'm early.
That's right. Yeah, I mean, with all the risk on, you think that the yields would have pushed on a lot steadily. Yeah. But this, I mean, it should have really sort of evolved into a more neater five-wave impulse, from 54. That was the mid-April low. We haven't seen that. So, yeah, I think that there's some funny things going on because, of course, governments are issuing a lot of debt at the moment. And, we're waiting
a little bit.
Yeah, we're waiting to see.
Everything with a T instead of a B now.
Yeah, we're getting used to that, aren't we? Which is a bit mind-boggling. But if I was speaking to some investment banks just yesterday morning, and they were saying, well, look, if the ECB, for example, are pushing in so much more bond buying, at some stage this is going to have an impact on yields and sending the yields higher, because it's going to be, if you're making issuance, you're going to be raising money, and that's going to put more pressure on raising money. That's going to rise the yields to the upside. And we have to be a bit careful that we're fixed on the correlations, where normally if a stock index will go through, maybe a 3-4 week correction to the downside, and we're used to thinking that yields will come down as well in a positive correlation, that's sending the prices up. That might disengage at some point. So we've got to be very, very careful about that, because there's traps involved, especially if the funding's rising. And we're seeing that certainly from the ECB as well as the Treasury in the US.
Okay.
I agree 100% with you, Peter. I do believe that at some point this relationship is going to perhaps even invert.
Very easily, couldn't it? Yeah, I think that that's decidedly possible, and so we've got to be very careful. I think the yields in Euroland, which we're monitoring with we're monitoring with the Italian yields. This is a really fun thing to do, because at the moment this is the Bund yields traded in Germany, and you can see they're inching up. It's a similar sort of very etchy sort of advance from sort of the end of April upwards here as well, but it could explode to the upside with all this funding around. But on the shorthand note, just be aware that if we start to get more downside today and tomorrow on the US markets, on the indices, S&P and the Nasdaq, just look and see how the behavior is working against some of these bond prices. If the bond prices are starting to rise and the yield's dropping downwards, then we can maintain that correlation for a bit longer, but not indefinitely. At some stage, these yields will have to explode to the upside. They'll have to.
Okay. So what else did you have in mind for today before Steve and I started?
Yeah, well, I was looking at a few cycles and stuff, because I just wanted to reiterate from when we looked at things on this post-coronavirus presentation I made a few weeks ago, that the S&P trends, the cycle is still up. I mean, I know that there's a lot of contention, because we've seen just this week the Bank of America Merrill Lynch Global Fund Manager Survey come out, and they've said that 68%, I think it is, of global fund managers think that we're still in a bear market rally from the March lows. But of course, we've been saying in the presentation that we made 2 or 3 weeks ago that that wasn't the case, that we've had everything lining up to show that major lows occurred in March. These were corrections mostly from the January 18 highs. And you can see on this particular cycle that we've got January 18 marked up here. And the cycle started to turn down. And it only, of course, bottomed in March, funny enough. So all the while we've been moving down and moving up into higher highs. This is, from an Elliott wave perspective, part of an expanding flat pattern. The cycle doesn't really show that intermediate sort of rally because it's so long term. It's a weekly composite. But of course, we can see how the pattern subdivisions are working to try and forecast something like that. But the cycle has bottomed, you see. So this is now turning up until we get to something like the end of 2023, early 24. So there's no doubt in my mind that we're on the right side of things in the bigger context. So that was just a quick update of one of the cycles. And then I think I did a cycle on the dollar. This is a composite daily cycle on the dollar.
Yeah.
Now we know that there's a 7.8 year grand cycle decline on the dollar index, which is peaking back in up here. Actually, it's in towards the end. It's the last quarter of 2016, first couple of months of 2017, and that's what this is picking up as well on a shorter term basis. But you can see the rhythm is mostly good in this. I don't predict price from the red cycle projection because this is only 2 elements, which is timing and direction only. It's not amplitude and it's certainly not pattern. So those 2 other aspects are dealt with FIB price ratios and the Elliott wave. But overall, when you look at the overall decline like this, I mean, we're eating time basically before we get this acceleration down. And then it lasts right the way through this year and into next.
So maybe what you're looking at here with your July 20 peak on this cycle, it's already almost June that we get this correction in the S&P time-wise. Maybe it's what, ABC into July, and the dollar rallies with the correction in the stock market into July. So am I interpreting it correctly that if the dollar is strong into the July timeframe, that would be a great shorting opportunity?
Absolutely.
July 20th? Okay.
No, absolutely, Dale. You're interpreting it just the way I see it, and that is that if we did get the dollar somehow going bid again with the stock market correction to the downside, then we are set up for this attempt at up into the end of this month and early July. So if we go back to the dollar index again, just to refresh everybody's memory, you know, we're talking about then something like this, you know, up to 101.96, something like that. I mean, that's why even if we break 98.65, I'm a bit reluctant to sell the dollar at the moment because of that. I'd like to see how it's behaving, just as much as we're looking for behavioral guidelines in the yields. I think we just need to be a little bit careful here. It's not an outright sell signal just because we're breaking down here at the moment.
Okay.
One other thing which I thought was interesting from a bigger perspective, I'm not sure if I don't think I showed this in presentation a couple of weeks ago, but something that's intrigued me, and we had some customer requests, particularly on the energy front, to update this XOP. This is an ETF on the gas, oil and gas index. And it's a rather intriguing pattern. I think that we've used our own special way of using Elliott wave to come up with this forecast, because I think most Elliott wave practitioners probably wouldn't see this pattern. But we have a certain way of building these types of patterns with FIB price ratios, and we came out with this idea that the oil and gas index on a longer term basis is trending up. And we wanted to see how that looked, given 2 things. One, the collapse in oil prices that we saw in April, and how would this verify a more protracted upswing over the next couple of years in this sector? And it does, because we can see that this pattern from up here back in 2015 at 336 is developing downwards into what we call an ending diagonal. And it's a 5-wave picture. So we go 1, 2, 3 in April, 4 up here like this, and 5. Of course, wave 4 has to burn some time, because otherwise this pattern doesn't work, and it must burn time. And what we used was a fib time ratio overlay, which is something I don't normally use day to day. It's something I use only in two circumstances of patterns. One is triangles, which are corrective by nature in Elliott wave terms, and the other thing is ending diagonals, whether they're contracting or expanding types. And it sometimes works pretty well. And so I applied it here. And what was intriguing was that it gave us a fourth wave rally into September 22. So if anybody's listening and would like to sort of put that down in their diary, it's an intriguing date that we'll come to later on, because that could be a terminal high, at the least earliest time for a terminal high in the secular bull uptrend for stock markets as well.
Interesting. Okay.
So that was something which I thought was a useful take home
Nice.
to show today.
Thanks for sharing that.
Yeah. And of course, when we come to things like, most popular things like gold, where are we in gold prices at the moment? Well, I've long since been sort of an advocate to expect gold prices go to record highs at some stage in the future, because let's actually have a look at this long-term chart, because basically back in 2016, when gold mining stocks bottomed, and we've been tracking in 2015 a low on things like Newmont Mining, and in those days Gold Corp and some of the others that got basically consumed within Newmont and Barrick Gold since. They were all bottoming in 2016, and we could see that bottoming formation in 2016 on the gold miners was actually ending expanding flat patterns that date back to 2006, 2008. And that evoked the idea and the concept that a new bull market would eventually unfold over a decennial period, so that's 10 years or more, and eventually trade into new record highs. And on some cases, where Newmont Mining bottomed around, I think it was $15, we're talking about an ultimate upside target of 166. So that just goes to show just how bullish we were. And that forecast is still in play. And if 166 on those multiples doesn't get gold into new record highs, then something's really wrong with gold. But I suspect probably what's happening is that we're seeing a moderate five-wave advance from this 2016-15 low, and that we've either finished primary wave 3 now, or we're about to see it finish. I can see today I had a very, very short-term downside target of 1703, and I can see that we've just nudged below it. So I might come back to that later tonight, because I'm updating it for our report tonight.
Okay.
And I might turn really bearish now, because and that means just lowering wave 3 down to this price area here, because that's looking as if a 5-wave pattern up from this August 18 low is completed. And that means a multi-month correction to the downside, which will probably look at something like this, at least a return back to wave 4 preceding. So we could be
wave
looking
4
at,
is 1450. Okay.
Yeah, 1540. So that's...
So would the line in the sand for the bull case in gold be, say, the classic conventional technical traders had that breakout at 1360, 1350? We should not see that again, or maybe the bull market is over?
Well, I know that there's been a lot of debate on gold, and some Elliott practitioners have said that, well, hang on, this is only 3 waves up. We could be looking at a secular bear downtrend still, and I do sympathise with that. I just think that one of the key factors that probably means that we're in a bull market and eventually go to record highs is the fact, which would eliminate 1300 and things like that, would be the fact that
the dollar.
That silver, which is also very fascinating. I mean, silver bottomed at 1164. Let's have a look at silver here for a moment.
Yeah.
And when we did trade down to 1164 in March, we completed a double zigzag downswing from this July 16 high.
Yeah.
And that was a 38% extension below the preceding upswing. And these are really sort of important measurements that define the pattern as well as a double zigzag. And that means that it's impossible for silver to engage in any sort of bear market for some foreseeable time in the future. And I think that this double zigzag downswing is the second sequence of an expanding flat pattern, and the last sequence, the third and last sequence, demands a 5-wave advance to about $25. So I think that that's probably where we're heading to over the next 2 or 3 years. As the dollar collapses, we get a commodity spike to the upside, and silver in this condition, you won't see gold trade down to 1300 anymore. That sort of possibility once has been removed off the table.
Okay, so we're set up for a wave 2 correction, price wise, time wise. It looks like this too could be a June, July setup. You're looking for under 15 for the pullback. You have any fib retrace levels for this will be the last bus stop. So okay, around $14, a little over.
Yeah,
14.
I think that's a 50% retracement. Why not?
Yeah.
You know.
Yeah. Okay.
Silver's been trading. You know, the gold-silver ratio has been out to about 120, I think, and it's contracted since to about 100 now.
Yeah.
I think it could widen out again a little bit during this phase, but probably won't widen a lot more anymore. I don't think so. I feel that when I looked at the gold-silver ratio the other week on the long-term basis that it's probably hit a top now, and that's certainly the case on platinum. Don't know if anybody's listening in today.
Yeah, Steve Volge likes trading platinum.
Okay,
he's a platinum bug.
Yeah, well, I mean, I'm a big buyer of platinum and have been since the low was met, because winding the clock back to pre-collapse in March, we had a downside target from 1,000 on platinum to
800 is nice support, since you mentioned it.
800.
Yeah, 800 is a nice support.
Steve trades palladium too. All right, so you're getting, there you go.
Yeah, okay, yeah, 793. That would be an interesting number. So around Steve's level 800 is going to be a certain short-term downswing to that. I think I used that by extending this by 61.8. Let's just check it, but I think that's correct. And if we then take a pause, we might end up a little bit lower. Yeah, so that's how that's derived, just by extending it by 61.8. That's just a tip for anybody listening in for measuring a zigzag. But generally speaking, this low down at 562 was a de facto low. And if we go and look back at the biggest long-term sequence, I think we've got something like this going on. So we're going to be going up to, I think we could be looking at some really significant advances in platinum. So if we go back to something like gold, which of course is in the news every day, should we be buying gold over platinum? No, we should be buying platinum over gold in this run.
You know, I for most of my career, platinum traded at a premium over gold.
And because you and I are not so dissimilar,
old guys.
It was the same for my period of time as well. Unfortunately, I probably shouldn't admit that.
And you know, the gold silver ratio used to be 40 most of the time.
Well, yeah, I mean, that's right. So, and going back to ancient history, it was about, I think, something like 15, wasn't it, in ancient history?
Yeah. Well, anyway, so you know, it's going to regress to the mean, just so that we could be, you know, so we can kind of, what's that called? Reminisce. We could reminisce decades prior. So anyway.
Yeah, I would. Anyway, I think platinum should be looked at, and you know, I think that's really, really exciting stuff. And I'm just going to have a quick check on the S&P. Yeah, it's still trundling off a little bit here. Sorry, the Nasdaq, I mean. So yeah, that's. Everybody keep watching that this afternoon, because I think that could start to fall down pretty quickly, and then we can check the dollar.
All right. Well, Peter, thank you. How do people follow you and subscribe and?
Right. Yeah. Let's.
Because you're not that active on Twitter, so people, you know, everyone looking for things for free, but. Yeah, you do have quite a reasonable price structure for your stuff.
Thanks. Thanks, Dale. Well, if anybody's listening in and you're intrigued about some of these forecasts, you can catch up with us at wavetrack.com, which I'm showing as our main first page. And if you just go to registration and subscriptions and hit subscription, The first subscription is for the Elliott Wave Compass report. That's a really good twice a week publication, and you can go online and see the charts online as well. Plus, you'll get a PDF in the post, the electronic post. But it's $39 a month, so it shouldn't break the bank, and we'd be very happy to welcome you to join and subscribe to that.
Thank you, Peter.
Thank you, Peter.
Yep.
It
Thank you,
was
Peter.
a pleasure.
Yeah, good stuff, man. So everyone, that's my trading warrior brother, Peter Goodburn. And he's part of my intelligence gathering, and appreciate your work, Peter. And it was a very nice birthday gift for you to share all your analysis with me and our community today. Thank you, man.
Great. Thanks to you guys. Thanks.
All right, everyone. So that's a wrap. I promise to get up in time tomorrow. Thank you, DJ. It's great to be 43. That's all I can say. At least I'm not saying 39 like Jack Benny used to for the rest of his life. But yeah, so 43, I can't go out and sing karaoke because, you know, we have a pandemic.
I can still claim 39 for a few more days and be honest about it.
Don't rub it in, man. All right. So anyway, don't just count your pips, count your blessings, and living another year, and, you know, sharing everyone's great work, our guests, the team, and a few of my guesses. I'm very grateful to still be here on bonus time. So thank you, everybody. Have a great day. We'll see you tomorrow. Thanks again, Peter Goodburn. Steve, thank you very much.
Thank you, Coach, and happy birthday.
All right, thank you, Guy. So we'll see everyone tomorrow. Adios.